There are almost a dozen CBDCs that are live today. None of them are in the developed world. Because in democracies, one of the attractions of CBDCs is the technological features, but they are very controversial in democracies. Imagine banknotes all had a little invisible tether back to the home office, and they could at any point snap it back.
Yes.
The ability to snap that back is very appealing for some non-democracies where, privacy or state power is less controversial.
Welcome to the Tao of Chao podcast, where we will try to find balance and provide a clearer path forward in this uncertain world. My return guest today is Dr. Elliot Hentov. Elliot is the head of macro policy research at State Street Global Advisors and is responsible for research and thought leadership linking policy impulses to financial markets and economics. He also serves as the State Street's chief geopolitical strategist and is a board advisor to Stablecoin Standard, the global industry association for stablecoins. He joined State Street from Standard & Poor's Sovereign Rating Group and previously served as an advisor at the United Nations headquarters in New York. He holds a PhD from Princeton University, as well as a master's degree in international affairs from Georgetown University, and has authored publications in Financial Times, the New York Times, Business Times, among other publications. And here is Elliot. Hello, Elliot. Thanks for joining me you're the first returning guest, actually, because I like speaking with you so much on Tao of Chao.
Well, thanks for having me again, Philip.
Today's topic is something that I was exposed to some 5 years ago, Elliot, when I attended the Shadow Open Market Committee meeting. And we're talking now about the central bank digital currency, affectionately known as CBDC. Sounds a bit esoteric for the average man on the street, but hopefully for the next 40 minutes when we're done, it will become kind of enlightening and is wonderful and exciting and different. So you've written and spoken on CBDC for some time, as you believe that blockchain finance holds great potential for efficiencies and market growth. So in this context, CBDC could be one important ingredient to advance these benefits. But you believe that this comes with some downside risks and challenges. So, Elliot, please give us, before we start into all the risks and challenges and good and bad, give us a quick review of the current sort of payment system, both domestic and cross-border. Give us a little review so that we have the framework for the discussion, please.
Yeah, well, thanks, Philip. And I think there's still a lot of confusion on this topic, so I think I'm hopeful that the next half hour we can shed some light on some of the key questions. One reason there's confusion is that when we think of money and currency, our first thoughts go to payments. How do I receive my money? How do I spend it? On that note, most of us think, well, we know how to do that. We have all these different various means to receive and make payments, and that is true. And if you think about it, let's say in the US context, the different ways you can do it, you can obviously wire money through the banking system. You can write a check, which is basically the old way of sending money through the banking system. You can use plastic cards, either debit cards or credit cards. And there's still cash. And so all these ways, and by now we also have apps and technological platforms that we'll talk about. But the key thing is that all those methods rely on a variety of layers of intermediaries. And these intermediaries do not do this for free. They're not just doing us a favor.
Surprise, surprise.
Yeah, exactly. They're taking a piece of the action, so to speak. And the idea is that with moving to genuine blockchain-based digital currencies, the costs of doing all of these things should go down further. And they're not small costs, by the way. I mean, we all think about, these great credit cards with these rewards. Well, somebody has to pay for that. And who's paying for it is all of us collectively by using these payment rails, whatever they are, credit cards, debit, the Visa, MasterCard channels. There's a fees associated with it, and they obviously fund that. And so the idea is blockchain finance holds the potential to get those costs down quite a bit. That's just for payments, just to start off very simply.
Right. So I want to emphasize a little bit about when people are listening to this, they say, well, no, it doesn't cost me anything to use the credit card if I pay it off end of the month. But actually, it's indirect costs that will come back to haunt us. And but everything is priced by the merchant of that little bit more to absorb that fee that they have to pay. So we actually are paying. It's just that we didn't even know we are paying. Is that a fair assessment?
Yes, and let's put some numbers on it. Roughly on average, for credit card transactions, the merchants are paying 2.5 to 3% in the US. In Europe, that's much less because of regulation, but that is paid by you and me as the end consumer. So it's certainly not free, and it really is all of us paying for it. And of course, not to speak of the high interest rates that are imposed by credit card companies and others in their business model.
Interesting. My daughter Carrera recently taught me how to use the wallet in my iPhone to pay for almost everything. So just last week, I've been clicking away, on my phone to pay everything from coffee to taxi to train tickets to everything. So even though we're using smartphone apps or electronic wallets, these are really not digital currency payments as the topic we're going to talk about. Elliot, with your expertise in this space, let's make sure our nomenclature or my nomenclature is correct. There's digital, there's crypto, there is stablecoin, and all the other thing is all on this thing called, or potentially all on this thing called blockchain. But can you just give us some definition so that we can move forward without making any errors?
Yes, and I think it's important because you spoke about digital money,
Yes.
which is using kind of the Apple Pay as an example. That is, in fact, digital and it is money.
Yes.
But it's not digital currency. Crypto are digital tokens that supposedly have a value issued by a private issuer based on their network of which the tokens are a part, having some type of economic or financial value. And so all of that is, we're not going to speak about today. We're speaking just about money and how money is used and what form it takes. And you mentioned stablecoins, and we'll talk about it maybe a little bit later in detail. But one thing I didn't speak about in the beginning was I talked about all these intermediary ways of paying. The one non-intermediary way of paying is, of course, using cash.
Yes.
And what is cash? Cash is central bank money. It's a liability of the government. You can always take your dollar bills and go to the central bank and pay your taxes with it. It's legal tender. All the other types of money that we have are not. They are actually liabilities of a bank, of a credit card company, or of a payment provider, or of some of the tech companies. It's not actually central bank money, which does make a difference. So it's not actually genuine currency. It's a digital representation of some private liabilities. Now, for us, you just talked about it in terms of using it every day. It's great. Why do we need anything else? I mean, it's super user friendly. You have your phone, and that's all you need. And the reality is, for payments in developed markets, we do not necessarily need anything else. The only thing we maybe would like is to pay a little bit less. I've talked about the transaction costs.
Right.
But in terms of user friendliness, a lot of it works already. Now, that's in developed markets and in China and some other places. But there's many countries where their payment systems are not very robust. The digital forms are not working very well. And blockchain could actually, going from having no landline phones to cellular technology, this could also allow them kind of to leapfrog a lot of systems. And finally, just because we will talk about stablecoins. Stablecoins are just private money, again, that are very efficient and have a lot of attractions. I think in the intro you mentioned I'm an advisor on the Global Industry Association of Stablecoins. They serve their own purpose, but they are also not central bank money. They are a form of private money and have their function.
So is it fair to say that what we are trying to put our arms around is how do we take the money we know, which is pieces of, I call it paper, dollars or pounds or whatever, and digitize it. So we no longer need to touch that. Everything is digitized. And by doing so, we'll cut out, as a form of payment, we'll cut out a lot of middlemen or middle people. And it's primarily, so far our discussion has been to save transaction costs. So bring inflation down, make it more efficient. But from a practice standpoint, it seems like we are not going to visibly or practically gain any more ease in using a digital currency than using it the way we are using it now. On that phone, as I mentioned, I click, click, click. My daughter asked me to click, and it worked. I mean, I can pay anything just about. So, from a consumer standpoint, unless we understand that we're really cutting cost, the efficiency is not any greater. Am I thinking correctly?
Yes, and that's also partially what makes this controversial or hotly debated as to why do we even need this. The consumers are pretty happy.
Yes.
So the reality is, I think the dirty secret here is that some central banks are pushing for a retail CBDC, a consumer CBDC, only to kind of put pressure on the financial industry to lower costs.
I see.
Kind of the threat of entry should basically already solve the problems of the high transaction fees. But that's for the consumer CBDC. What we haven't talked about, it, which is I really want to spend most of the time speaking about here, is the wholesale CBDC. So the digital currency that kind of operates in the background, kind of behind the layers of financial architecture, where the technological features enable certain things that we haven't been able to do in the past, or to do them much better. And that's really the promise of the CBDC. So less so on the retail side, maybe just kind of as an engine for change and improvement of our existing stuff. But the wholesale part, the one that basically will be used by banks, clearinghouses, asset managers, and so forth, that is where the big excitement lies.
Just one more question on the consumer side for us, and then let's go into that more interesting stuff, or seemingly more interesting, is that if we have a digitized dollar, everything can be digitized, and basically the Federal Reserve, the U.S. Treasury, come up with this whole scheme. We almost don't need a bank, right? I mean, everybody just have a digital wallet, go directly work with the central bank. Is that fantasy, or is that realistic or not realistic? And we basically disintermediate some functions of banks altogether.
That would be a risk in theory. In practice, most central banks are aware of that, and they don't want that. They don't want to be dealing with 330 million Americans and their wallets. Probably, frankly, that's also not what central banks are good at. So they will continue to rely on intermediaries to manage these the wallets in the consumer case. Either way, you'll continue to need a financial infrastructure that kind of reviews individual customers and has the interfacing for the end user. But again, that's less where the big gains are to be had on the consumer side, and the big gains are had on presumably on capital markets efficiencies.
So
kind of on the investing and borrowing side of the economy.
That's where I was going to go. So if we're going to use blockchain and make it more efficient, use the digitized currency, there's significant benefit, right? Or that's what we understand. Because it will be the basis for clearing investment transactions as well. So that's where I get a little confused. So maybe, Elliot, start talking about that is really an important element for a much bigger issue or bigger solve that we're trying to accomplish. Can you introduce that a little bit better than I have?
If you think about any type of transaction that is done beyond a simple payment, so again, payments take a lot of our attention because everybody does them every day.
Right.
But you, as a veteran investor, so to speak, on behalf of your clients,
yes,
you're investing assets, so you're purchasing assets. There's actually a variety of steps that are taken to ensure that you convert your currency into that asset. That asset is identified, the transaction happens, the pricing happens, the custody of the asset happens, and then later on, also for reporting purposes, you know where the asset lies, what the value is, and maybe one day you do the same in reverse during the sale. Now, there's a lot of steps and a lot of players involved. the industry has grown and is very mature and sophisticated, but there's a complexity to it that can actually be reduced. And the idea is, right now, these are not really digital. What we have today with computers are digital representations of everything. We have a digital representation of Philip Chao, who has an account with the brokerage that's digitally recognized. And then there's a digital representation of the bond or the stock you may have purchased for yourself or for your client. And also, but in reality, that all these things are not what you see on your computer screen is just representing, frankly, real reams of paper that still exist somewhere. There are actual still stocks, shares issued in some shape or form. There's bonds issued, and those issuance have to be tracked and reported carefully. And so therefore, only because it's on your computer screen doesn't actually mean you hold it. You're actually relying on your broker to have done the due diligence of holding the correct security, having purchased it at the right price and custodying it in the right place. And a lot of that can actually be short-circuited if I tell you that the security itself, it's not a representation of the security, but it's the actual security is in code. So therefore, that code that is on your screen, you can actually move it directly. So it sounds very abstract, but in simple language, it just means we need fewer hands in the pie. We need fewer stations of passing it around, and we can do it much faster. And that's a huge efficiency gain that will show up. We can also do, by the way, let's talk about it later, but we can also do things that we couldn't do in the past because of that.
I understand what you just said. You're talking about a transaction from buying a security, whatever that may be, custodying it, going through all the different parties necessary, verifications and so on, and then selling it and so on, and putting the money in, taking the money out.
Correct.
And there are many parties involved. And what you're saying is, right now, we look at the screen as if it is digitized. Actually, it isn't. It's just a representation or make believe it is digitized. And then if you digitize it, it actually cut out some of the inefficiencies and possibly, like you said, fingers in the pie, fewer fingers. So not only more efficient, but lower cost from a transaction standpoint.
And that is correct.
Now, why is CBDC becoming an important component? I mean, couldn't we just do this without CBDC?
Yeah, well, just think about how do we do it today. So I'm even skipping a few steps, but when you invest in an asset, you purchase an asset, there has to be a messaging on the back end that coordinates your finances, so the pool of cash or the money that you're going to pay for that asset. The asset has to go to a transfer agent, and then goes to the custody, the broker. There's a variety of steps that have to happen, and on the back end, the financial exchange, also there's several steps that happen that make sure that we're actually drawing on the right pool of money to pay for it, and that there's confirmations along the way that money was transferred, and there's messaging between the different banks to say that we've received it, and therefore we can now, in exchange, message back that the bond or stock you're buying gets handed over. Now, the reason why we cannot fully do that with the existing system, or what we can do with a CBDC or a stablecoin, is that all these steps, there has to be money that exchanges at the same time in the same language. So the computers have to be able to speak to each other. The code has to be interoperable or harmonized, and we cannot do it with our existing system. So yes, we could theoretically have a digital bond, but then the digital bond will still have to wait for all the back-end messaging and transferring of the money with our existing system. So this is now where digital currency comes in, where you basically have it all blockchain, it's all coded in a similar format, and therefore you exchange directly the bond for the money. And for that, you need money. You need blockchain money. And there's probably even more forms, but there's two very credible forms of blockchain money that are basically the settlement currency, the currency needed to make all these transactions happen and enable them. And it's either a CBDC, so central bank money, or it's private money, which right now, stable coins are the best form of private money because they're backed fully by collateral that everyone trusts and understands indirectly.
Mm-hmm.
But what you need is blockchain-based money to do that. And that starts to open up everything, because then you get this whole seamless process on the chain, on the blockchain itself, and you don't need all the fingers in the pie, because you can have direct trading between $1 worth of token of either central bank money or stable coins, equivalent to $1 of the bond or the stock that you wish to purchase.
In order for that to happen, the tomorrow picture, the tomorrow that you just talked about, everything has to be operating through this quote unquote blockchain system to bring the kind of efficiency you're talking about. Anytime any portion it isn't, then you go back into inefficiency. So you really are talking about a global change from the current to what's the possible on every part of the transaction. Otherwise, it's not realizing the benefit that you and I are talking about. Is that right?
Yes and no. I mean, in principle, where you're right is this only works when you create the network effect of entire markets moving to it.
Right.
Individuals, obviously, it's not as beneficial. But you don't necessarily need all securities in the world. It just could be the securities that really benefit from this. For example, equity market is actually already fairly liquid and fairly efficient.
Yeah.
The blockchain version of equity trading delivers some marginal gains, but they're not huge. But fixed income, it's very different. The fixed income market is still very fragmented. It's still very much, a lot of it runs on over-the-counter, less exchange-based. There, the nature of fixed income with coupon payments and rates built into individual bonds, with bonds having different maturities and different investor profiles, that's where you get the efficiency gains can actually be huge. So, but you're right. Ultimately, as an asset class as a whole, the entire network has to go with it. But it doesn't necessarily mean all assets everywhere at all the time. It could just be certain segments of a market. But the market as a whole has to go for the gains to really be present.
And we are probably not going to go there, but also the fractional ownership of illiquid assets can also be part of that. I understand at one time New York City had a co-op or an apartment building that was people are buying fractional ownership through some kind of blockchain process. And so if that's also on the blockchain, then I can build a portfolio of liquid and less liquid or even illiquid assets, and actually making it liquid, all of it through the payment through CBDC, and cut out more middlemen. Am I thinking accurately, or is that not part of your ecosystem?
No, absolutely. Look, we spoke a lot about three big advantages. One is fewer intermediaries.
Yeah.
Second one is faster settlement in general, because you have fewer intermediaries. You're not the lower transaction costs as well as a result. So those three we've spoken, I think, a lot about. Now you've brought up the fourth advantage, which is fractional ownership, and that's kind of the new world.
Yeah.
And that means all these assets that are out of reach for a lot of people could suddenly become within reach.
Yeah.
By the way, it doesn't not only apply to, I mean, real estate is kind of the holy grail, because real estate is kind of the largest asset class in the world if you add up all of existing real estate globally. If you can find forms for lowering barriers to access, that obviously that as an investment class could grow a lot. But it's not even, you think of even shares. I remember always wanting to buy, just not having enough money for a Berkshire Hathaway stock, so to speak, when I was younger. And even existing financial assets that may have a price tag that are too large, you want to encourage young workers to start saving. Certain strategies didn't work when you just have $20, $30, $50, $100 to invest. But that could all become very, very much a possibility in the future. So fractional ownership is a very big topic. It's not only real estate, it's also private equity. Think about where the big gains have been made. Where has a lot of benefits accrued? It's been in private markets. And so that's the holy grail. But there's also other advantages we haven't spoken about. Because it's code, and you can build things into the code that add further efficiencies. For instance, on bonds with smart contracts. Right now, you have a bond that issues you a coupon payment at a certain time. And then you have to just check, there's a settlement time that takes. Usually it's T plus a few days, depending on the bond. And then if the money hasn't arrived in the bank, only then do you start talking about kind of a missed payment or so. With a smart contract, that all can be automatic, where the code automatically has access to the pool of money that will make the bond payments. And so therefore, even if the counterparty doesn't like it anymore, they have no control. Once they've issued the bond, I've purchased it, the tokens will flow completely automatically and almost irreversibly, regardless of human interaction. That's a huge efficiency gain, not only in terms of actions that need to be taken, but also in terms of risks. My risks in terms of credit risk decline to some degree because there's fewer counterparty risk, or the collateral that for which I purchased already was ascertained, and so therefore some of the costs of risks go down as well. So the huge other potential market gains, market efficiency gains in the offing.
And I know for sure cross-border exchange is going to be, that's tremendous cost right now, from converting my currency, going to the bank, wiring it out there so that I will send money overseas, either because every month I give money back to my home country, or I'm buying something overseas in their currency. The whole exchange rate and all that cost will come down as well. Not only speed, but the conversion and all the intermediary involved. And so if we invest in international securities, either bonds or stocks or what have you, that will significantly reduce as well. Is that right?
Yes, but that's a bigger question mark, because that depends a lot on cooperation, like anything else in global trade, on cooperation between global regulators and governments. And so I would say that's the least certain part around what the evolution is. We know that in capital markets that are run by one single regulator, the benefits can accrue much sooner and much more clearly. There can be, very distinct regulatory guidance. The market incentives can be created that all market participants converge around technological standards and macroprudential standards,
Right.
and that allows the market to take off. What you described in foreign one is, I think a lot more has to happen. There's still a lot of, in many jurisdictions, there's uncertainty around the technology, whether it brings systemic risks. Where do you, what if you have code errors in the code somewhere? How do you intervene? Who's responsible?
I see.
With the blockchain, it's no longer just around banks or usual financial participants. It's about validators of the chain, how the nodes are run, who's basically responsible, how decisions are made over chain governance. There's a lot of, we're still early in this process.
Mm-hmm.
There's still a lot of open questions. So the cross-border dimension is I think that's further away than the domestic one. And the domestic one, by the way, depends really on which country we're talking about, because some countries are very well ahead in terms of creating a regulatory framework, saying, now market, you go, this is the guidance, and others are still dragging their feet. But back to the original topic, for all of this, again, just to remind everybody listening, for all of this to happen, you still need money that talks in the same language.
Yeah.
And that's why you'll either have to have stable coins as the settlement currency or central bank digital currencies. And you could maybe have both or either, depending on the setup of the architecture. But you'll need blockchain-based money.
I took a course a few years ago, and there was a capstone project that each student has to do. And I end up getting the wallet one. So I just want to test it with you. Today, this is already possible, I believe. Let's say I want to pay you something because I bought something from you, Elliot. You are in London, so your currency is different than mine. So what I would do is we agree that it's going to cost me $1,000, whatever that means. So I go and I have a wallet that will buy, let's just say, a stable coin for $1,000. So that represents 100 stable coins. I'm just using that as an example. I push a button, your wallet immediately receives 100 stable coins. That 100 stablecoin happened to initiated by me of $1,000. You then take that stablecoin and say, but it represents, 870 pounds on your side. You convert it into pounds and you got your money. Right now, that is possible, if I understand correctly. It's just a matter of conversion. How much does it cost for me to spend $1,000 to buy this 100 coins or whatever coins it is, and how much does it cost you to convert that 100 coins into your currency? Am I thinking correctly in that, or am I correct in that?
That's very much possible today, and the reality is some companies are already taking advantage of that route to save money and to save speed. So you can really do this all. This
is happening, right?
Exactly. This can happen close to instantly, and because it's all the capital cost even for the converter, for the FX provider, is very, very low. The fee to do this, or the transaction fee, can be incredibly low, much lower than established exchange houses or banks that have been traditionally in this area. So yes, that what you just described is certainly possible.
So the inefficiency is really because I'm not buying it with digital currency. If I buy it with US digital currency from the central bank, that will skip another step, because then I don't have this conversion issue, because now I have to first convert into a stable coin, which we can talk, just sort of introduce that topic. And then for the stable coin to then go to you, and then for you to then convert the stable coin into your usable currency locally. If I have a digital currency, I don't have to convert it. If the digital currency will be the one that will go over to England. In England, you still have to do a conversion. But I will skip one conversion here to get through, because then I don't have to buy a stable coin. I would just give you $1,000 immediately. Cut out the banks altogether, actually. As far as I can see, why do I need a bank? I just use this wallet idea.
Yeah, exactly. So the wallet provider would still be there. There would be some intermediary, because the technology requires that.
Right.
Right now, you mentioned correctly, there's a barrier to entry, because you need to convert your regular money into blockchain format in a stablecoin.
Right.
In theory, you would have a wallet full of stablecoins that would basically be one form of your regular money that you would be using for this type of transaction, and you would always have that available. So in the future, yes, that is one example. Again, it's very payments focused.
Yes.
Where there are gains, but the gains are almost less impressive than on the other thing, which is when having the stable coins or the central bank digital currency to do some of the more elaborate capital market transactions and really leverage the benefit from that.
So where do you see CBDC now in the developed markets? Let's just look at United States and its allies. How far are we in thinking or even taking action in CBDC? And are we all on the same page per se on the large central banks? Let's just pick ECB, Fed, and Bank of Japan. Just for example, pick those three. Are we on the same page?
There are almost a dozen CBDCs that are live today. None of them are in the developed world. They're all in emerging and frontier markets.
Okay.
The large developed central banks have all decisively committed to being ready for a launch, i.e. having the capability to do so. But as I mentioned, the case is not clear in every instance whether a retail-facing, a consumer-facing version is necessary or desirable, whereas the wholesale one looks like the case is fairly strong to do so. Again, each jurisdiction may decide differently. The ECB this week announced that they are basically ready to create the digital euro. The Fed dollar is still more in the exploratory phase. The Bank of England will soon release a final commitment, but it is strongly veering towards launching in the coming 2-3 years. And the idea here is because in democracies, one of the attractions of CBDCs is the technological features, but they are very controversial in democracies. One is theoretically the trackability, so the loss of privacy. There's ways to mitigate that, but because people will be worried about it, large-scale usage at a consumer level will probably never be appealing. And the second one is the programmability, the idea that you can program something into every dollar, saying, well, this dollar can only be spent on transport, or this dollar can only be spent in retail. And neither the Fed or ECB ever have any thoughts of doing anything like that. But the sheer plausibility or potential ability to do so is another reason why consumer-facing versions of this are never going to be in large scale in the developed democracies that we know. In contrast, in emerging markets, those features that I just described are precisely why the authorities are pushing ahead of them, because not because from day one they want to do that, but they love the idea that the state would have the potential control to do so. And that means even countries like China, that where the capital count for residents is largely closed, they can open it a little bit more freely with the knowledge that, well, if something goes wrong, we can basically change the code at headquarters and change the function of our currency usage at a later stage. That ability to kind of claw it back, almost like imagine banknotes all had a little invisible tether back to the home office, and they could at any point snap it back.
Yes.
The ability to snap that back is very appealing for some non-democracies where privacy or state power is less controversial.
So the more the developed market thinking about potentially, if it does CBDC on the retail side, not just the wholesale side, but really replacing physical currency, which apparently not too many people use. Well, not in a legal way. They're not using it as much as one used to. Because I'll ask my daughter, she has no cash. Anytime she has cash, she said, "Can I give you the cash and you just send the money to my bank?" I would always say yes, and I would charge a small fee. No, the fee is I pay her more. She gives me like $23.70. I give her $25. I mean, that's my fee to me, not fee to her. So my point is, I understand that China when they had the Winter Olympics, is the first time that apparently they're not using Visa, because Visa used to be the biggest endorser for Olympic Games. And they instead replaced the Visa with digital currency, the renminbi. China is really pushing that. I think they want to replace cash with CBDC for all the reasons that you mentioned. Maybe there are others. But really, there is also the pushing their CBDC, perhaps, is this whole geopolitical thing, right? To get away from control that is being established in the Second World War, or even longer. I think the SWIFT system of controlling the bank to bank, how money get transferred and movement. Am I thinking correctly that CBDC is creating new highways to do commerce or to do exchange of transactions between any two parties, be country to country, merchant to merchant, B to C, C to B, B to B? That is just building a new superhighway. Am I thinking correctly in that?
Absolutely. That's absolutely right. And if you think about it, the reliance, all these intermediaries we talk about, it's either banks or it's SWIFT, which is the banking messaging system that coordinates between banks. That's also been the epicenter of how Western sanctions have been applied. When we talk about getting rid of intermediaries, well, you don't need a messaging system between banks if you basically have a blockchain ecosystem where central bank liabilities can be moved around directly between participants. Well, then you don't need any of these intermediaries. And if you don't need those intermediaries do not offer a surface area for sanctions and attack either. And so, yes, that's one. The geopolitics are clearly, and we're publishing a paper in the coming days on specifically the geopolitics of CBDCs, are a real reason why there's a lot of thrust behind this effort, even when the urgency on the payment side is not large, because the implications of how money moves around, once it's kind of like physics. It follows the path of least resistance. And if you
Yeah.
basically build the super highways you described where money can flow most easily, well, then that's what it will do. And that has obviously a geopolitical dimension because different adversaries want money to flow in certain areas or don't want money to flow in certain areas.
So two things. One is the more the West, United States primarily, weaponize this, currency, where the banking system, the flow of money and sanctions and so on. The more you are pushing, countries either are sanctioned or countries are afraid that they will ever be sanctioned. So we're really talking about the global South, for example, to say, gosh, we really do need to do the superhighway. And that become more and more of a reality. So in some way, we in the West or the United States is sort of the pushing hard to try to change behavior and punishing those who behavior don't meet the standard of today's world. The more likely that we will lose that power in the near future or sometime in the future. That's one, because we're basically telling them, hey, if you want to not get sanctioned, go figure out yourself how to clear all your transactions. Go do it yourself. Number two is assuming that China and other countries like China, one of the motivations among many others you mentioned is, maybe we can pull those strings by having CBDC. We will know every transaction. We'll know where all the money is spent. We will know flight capital. We can pull it back or do whatever. Knowing that, does it not the same idea of really pushing for competitive private currency like stablecoin as a competing force? Because we also don't want the authoritarian regime to know everything that we are doing. So I rather pay a little bit of transaction costs, but I get the freedom of money movement. So it sounds like to me, there are many things going to happen, and the saving transaction cost is only one thing for the average. But for others who are motivated by freedom or democracy or just simply not wanting anybody else to know, they are willing to pay more to be safe with their money. Is that a thinking that you also feel or talked about?
So on the first question, that train left the station a long time ago, even before the Russia-Ukraine sanctions, which were really the big bang of financial sanctions. Iran, Russia, and China, each of them have been developing their own interbank transfer system for many years. China's went live in 2015. It's now being increasingly, Russia has plugged itself into China's system, and other countries are joining that. So that's still not blockchain. That's just kind of conventional interbank transfer system. So that has happened, and that has obviously happened because of the fear of Western sanctions. You also spoke about that there are reasons why you don't want to have all your eggs in one basket in terms of any system or any type of money form, and that's also it's on the margins. It's one of the reasons why stablecoins have a role to play in this ecosystem, maybe even a dominant one for a variety of reasons, just because of being private sector actors. So this is obviously the question I get a lot is, well, this sounds a lot like de-dollarization, and we move away from Western payment rails. That's all very true. And so on payments, and again, payments is just the flow.
Yeah.
On the flow, this can make a big difference. Like whatever money that doesn't have to be routed through the Fed New York, that doesn't have to be routed through the European SWIFT system, that gets diverted. And that's what we see right now, a big switch away from these alternative payment rails. But at the end of the day, the money has to flow into something.
Mm-hmm.
If you're buying a good or a service, then the person selling you that good has a stack of currency.
Mm-hmm.
And if they have a lot of foreign currency, they have to put that somewhere.
Mm-hmm.
And they can either put it domestically, which will probably make their currency appreciate or trigger inflation, or they have to reinvest it abroad. So the stock of assets, you cannot escape that. And that's really the big financial sanctions of last year were really around that. And that blockchain does not change that in any shape or form. Most of the surplus countries need to invest their money primarily in dollars, but also yen or European currencies.
Right.
And that's also where the sanctions exposure still resides. So it doesn't solve everything, but on the margins, maybe the next time we meet, I can talk about where the expansion of cross-border capital markets on blockchain on the margins can minimize some of this exposure.
Do you see, instead of keeping money in the US dollars the way that you talked about, China created the global supply chain, US ultimate consumer, they sold all that stuff to US, they pay in US dollars, the money stay in US dollars and invest in US treasuries, which gave us 20 years of very low interest rate environment, yada, yada, yada. We know all that. What is stopping China or somebody like that to say, no, we don't want it in US dollar. We want to put it in some kind of tokenized currency, which doesn't really exist. It's not a country currency, just a token. That token then can be used to buy, in our prior conversation, it's a digital currency that we can buy stocks, bonds, anything, anywhere in the world that we want, not just concentrated in any one country's U.S. Treasury, for example. Is that truly an alternative? That even if they say, well, we don't want to invest it, we just don't want it to be controlled by the U.S. Even though we sold all this stuff to U.S., we don't want U.S. dollars. We want to convert every U.S. dollar into a token. And that's it. We call it a day. Or somebody will come up with this, hey, if I get your token, I will give you interest for that token, pay it to you in token. It's like a whole alternative world. Is that doable? No.
Everybody's asset is somebody else's liability.
Yes.
And at the end of the day, there is no escaping from this. Well, let's say you put it in some token. Well, the token issuer then has all this money. They're not going to just sit around on it. They have to invest it somewhere. And look, what when we talk about stocks and U.S. equity outperformance, U.S. equity market cap is now more than half the global stock market capitalization. Good luck investing in equities without investing in the U.S. in a global portfolio. Again, the Ukraine war showed us that when we talk about the U.S., we're really talking about the G7. Most of Europe, Japan, U.S. and Canada. That's in most capital markets. That's the overwhelming majority of financial assets that they provide in equities, in fixed income, and so forth. So if you are sitting on a lot of assets and you need to invest them, you have a very little choice in today's world. And so that would have to change. You'd have to have a big growth in capital markets elsewhere, or you have less money accumulating elsewhere that needs to be invested. But that's a macroeconomic balance of payments question, and less one related to blockchain.
If the global south has its own version of a blockchain or CBDC, or China has and Russia has or Iran has, then the West, even the West, it may not be exactly the same, the US and European Union. Is there any friction that you see? I'm a bit naive about exactly how that will work, because right now everybody have their own currency, their inefficiencies. How would that work in the future if we are not on the same standard of what a CBDC is or the same blockchain or what have you? Does that cause a problem or not really, or is it a solvable problem?
No, I mean, I by and large, I'm worried that the emergence of, for all the reasons we talked about, why democracies and non-democracies have different incentives around the design of their digital currencies. I ultimately think that it's going to contribute to financial fragmentation globally, because obviously certain blocks of countries will have an incentive to basically allow for more and easier financial integration, whereas other blocks may actually be skeptical and may actually be quite happy to maintain barriers. And so it's beyond the scope of this podcast, but there's different models for how you arrange for cross-border interaction. Some basically require a lot of economic integration, and that can be good. That can be kind of like a European Union scenario where countries want to basically be politically close, economically close, and therefore they design it around it. But it could also be kind of the other feature where it's more geopolitically driven, where a bloc simply does it because the dominant power in that bloc is creating the incentives to tie nations closer to it. And then there's also a model where it's around we don't have that. We just have kind of the Swift equivalent in the blockchain world that intermediates between these different blockchain digital currencies. And that's also a model that could work. It all has, but by and large, the implication is that we will definitely not have one global system that's harmonized. It'll be multiple competing systems, like we have it in the world of trade and services.
Sounds like the same conversation we could have on AI. The same, it's like this is fragmented. The world is fragmenting, and I'm afraid that it will not be a single system. I mean, I don't think I'm predicting anything that anybody is not agreeing to, but it's a more fragmented, fractured, I think in some way more dangerous world. Elliot, I don't mean to end on that note, but we have to end somehow, and our time is up, I think. It seems like we only scratched the surface, because I've learned a whole bunch just listening to you, and to the what and the whys and the hows of some of these questions. And it's been educational and fantastically interesting discussion. And thank you for being my return guest once more. And I look forward to continuing our conversation.
My pleasure, Philip. Thank you for having me.
You can always find more episodes by visiting philipchao.us/podcast, or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchao.us.
Views expressed in the Tao of Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.